Welcome, and good morning to y'all. I'm excited to be here with y'all, and I want to thank Mike Holt for the opportunity to be with y'all today. I want you to feel good about what you're going to hear, because what you're going to hear has helped some companies save hundreds of thousands of dollars in lost profits and revenue. And to some of you, it could mean millions of dollars in lost profits and revenue. Now, today's topic, keys for profitability in the new economy, couldn't be more relevant during these economic times that we're in. A little bit about me quickly. I'm not just a consultant geek. I do enjoy barefoot water skiing, but what I really like to do in my spare time is teaching people with disabilities how to water ski, and that's what I like to do for fun. In my day job, I'm what some call a financial risk consultant. What does that mean? We deploy resources that are designed to have a positive impact on your financial statement. And I've cut my teeth with electrical contractors 31 years ago. Been doing this a long time. Been a continuing education instructor for associations for many years. Enjoy teaching. And as Belinda said, I was recently a published author. It's out on Amazon. The book, Accidents Waiting to Happen, Best Practices in Workers' Comp Administration and Protecting Corporate Profitability, actually was born from this workshop. The workshop, again, goes over a lot of information, but the book goes into a lot more detail and has a lot more resources. So if you like what you hear today, the book will go into a lot more detail for you. Let's go ahead and get started. If you're like any successful business that I know, you have got to find ways to control your expenses. And most every one of you are having to do more with less employees these days, right? Clearly, everyone is out there trying to raise revenue when you can find the work. But let me ask you this question. If you were to change or modify some policies and procedures in your company, and it had the impact of increasing your revenue by over $1 to $3 million, who would like to know how to do that? See a show of hands. I'm going to show you how some companies are doing just that, and I'll share with you a client, manufacturing client, who actually increased their revenue by over $13 million from some of the things that we'll be going over today. Some of you have had your profit margin squeezed. I was talking with a contractor just last week who was accustomed before the Great Recession of 2008 hit of getting about a 20% net profit margin. Today, he's earning about 4%, and he hates it. I know people who would probably love to get a 4% net profit margins today, and there are the unfortunate companies who've had to let go in the last several years. Some of you need money in order to pay for capital equipment, in order to make repairs to the equipment that you have, and in order to help you be more competitive in your marketplace. And I'll share a different perspective on profitability that might help free up some money for you to do exactly what you need to get done. Now, my goal today is to teach you some best practices, or reinforce for some of you some best practices in the area of workers' comp administration and protecting corporate profitability. I'm going to share with you some insights, things called T-Core and what they mean to your business. And I'll share with you a system called PX4 that is designed to help lower your administration cost, lower the cost of your claims, and ultimately help you in increasing your profitability as a company. Now, if you can remember just two things from today, I'd like you to remember this. If you reduce your business risk as a company, you can and will increase your profitability. And number two, know your blind spots. Know your blind spots. Number one, New York best-selling authors Larry Bossidy, Ram Charan have a book called Execution that says that too many leaders fool themselves into thinking that their businesses are well run. Some of you have heard the comment, sometimes we don't know what we don't know. It's happened to me. Well, there might be some things that might be light bulb moments for you today that you might take back with you to help make your companies more profitable. As we go through today's workshop, I'd like in the margins there, ask yourself these questions as it relates to training, hiring, and your claims management. Number one, what kind of policies and procedures do you have in place right now? Number two, are they working for you? And lastly, what could be improved? Now, obviously, I can't answer that question for you. You're going to have to do that on your own. But be honest with yourself as you go through this. But what I'd really like to have you do is I'd like to challenge each and every one of you to set some goals today in workers' comp administration. And I'm not talking about your policy. I'm talking about workers' comp administration. And you may be thinking, gosh, Rick, I don't know what kind of goals you're talking about. Well, to help you prime the pump, these are some things I'd like you to be thinking about. How can I reduce the number of claims within my company by 20%? Or how can I reduce the claims cost themselves by, let's say, 15%? What if I want to create a new hire checklist that makes my hiring process easier? Or what if I want to find out what my risk score is in the next 30 days? These are all attainable goals, but so be thinking down that track. Another reason why you want to listen to today's program is because I trust many of you probably consider yourselves to be competitive. And I trust you do not want to have your competitors pass you by. And I will tell you that a lot of your competition is already starting to do many of the things that we'll be talking about today. And I would tell you that you'd be putting your company at risk if you don't do some of the things that we talk about today. Share with you an electrical contractor who had some real entanglements with some claims that cost him over $1.2 million in revenue and over $251,000 in profits. And I want to protect you or keep you from having that happen to your companies. Manufacturing company I was just alluding to earlier, they were averaging in the last 3 years $318,000 in losses over a 3-year period of time. And I said averaging. And doing some of the things that are taught that you'll be hearing today. In 1 year, they lowered their claims down to $27,000, under $28,000. Their loss ratios were averaging 174%. Now they're under 10%. The acceptable loss ratios that carriers look for these days are actually something under 40%. Now, I don't need to see a show of hands here, but has your company had to deal with an employee lawsuit in the last 3 to 5 years? If you have, sorry to hear that. We all know they're extremely frustrating to have to go through, and notably, they're very expensive for you as well. What's the oldest lottery game in the United States? It's the employee lawsuit. Now, let me ask you this. Let's say that you've got an employee who you think is taking advantage of you, taking advantage of the system, and you get sued for a small $15,000. I'm going to come back to that question in just a second, but let me ask you this. The average settlement costs right now in the United States for cases that don't even go to trial, let me ask you this, your first question. Do you think it's closer to $30,000 or do you think it's closer to $60,000? Who thinks it's $30,000? The average cost of cases that don't even go to trial. Let me see a show of hands. $30,000. Who thinks it's $60,000? It's actually $32,000. Good guess, though. Now, those same cases that actually go to trial, over $300,000, $310,000. Big money. Now, getting back to the question I was just asking, if you get sued for $15,000, how much do you think that claim actually cost your company? It's actually over $50,000. And here's your next question. See a show of hands. Thanks for responding. If you were sporting a 4% profit margin, how much sales do you have to generate in order to pay for that $15,000 claim that turned into $50,000? You think it's closer to $500,000, or do you think it's closer to $1 million? Who thinks it's $500,000? See a show of hands. $500,000. Who thinks it's over $1 million? Well done. $1.2 million. Big money. Big money. Now, I'm speaking with you today under the premise that you have a pretty keen awareness of 2 key points. Number one, insurance companies are just not wired to look after your best interest. And number 2, claims cost you money. They cost you big money. And depending upon how they get managed can absolutely determine your profitability as a company. Now let me see a show of hands here. Who has had a workers' comp claim that just really frustrated you? You see a show of hands. See a lot of people that happens to a lot. Why does that happen? Communication is probably the biggest culprit that we hear. And where does it start? Starts right here. Overwhelmed claims adjusters. Even insurance companies are having to do more with less people these days. And there was a consulting firm by the name of Conning & Company. They put a report out several years ago that they said that the average caseloads of the average adjuster was anywhere from 100 to 150 files per adjuster per month. Today, we've heard upwards of 250 and 300 files per adjuster per month. Kind of begs the question, do you really think the insurance company adjusters have time to micromanage the cases that you might have, whether they're one or two or many? I think you can pretty much answer that question on your own, right? Now let's talk about this. The insight called TCOR. The science of TCOR has actually been around since 1974 by a guy by the name of Frank E. Bird Jr. And he had a publication that was called The Real Costs of Accidents Can Be Measured and Controlled. Now I'd like everyone just to stop, and I want you to think about how much you pay in premiums right now and jot that number down in your notes section right now. Jot that number down. Everything, your property, your liability, automobile. Jot that number down. And I'm on number 6 in your notes for those that are keeping up. What the science of TCOR states is this. Whatever you're paying in your policies and premiums, and just give you an example, let's say you're paying $100,000 in premium. What you pay in your policies and premiums only represents the tip of the iceberg. And if your premiums were $100,000, your total cost of risk is conservatively under $1 million, which means that your bigger cost to your company is not what you pay in policies and premiums, it's what's below the waterline. How much did your last bad hire cost you? If you had someone, who here has had someone work for you for 5, 6, 7 months and left you? See a show of hands. It's happened to a lot of people, right? It's happened to me. Statistics say if you've got someone working with you making $35,000 a year and they leave you or you're fired or whatever happens with them, it costs you probably closer to $75,000. Big money. The cost to retrain, the cost to rehire, HR having to be involved, potential lawsuits. It's extremely expensive to your company. Very much. Let me have you think of this. When you've had agents or brokers come and talk to you about your program, you're generally hoping for lower cost, better coverage, better service. But when they usually have conversations, where do you spend most of your time talking about? You're talking about the policies and procedures, right? And let's say someone does come in and they save you 10% on $100,000 in premium. Well, that's good money, 10 grand. But what's being done to address the other 80 or 90% of where your bigger costs come from? Now, if you've got a firm that comes and talks to you and is able and successful to lower your TCOR, your total cost of risk, by the same percentage, now you're talking some big money. I don't know about y'all, but that's the part of the spectrum I'd rather be on. So the moral of the story here is make sure that you're dealing with things beyond the policies and premiums. Look for resources that can help reduce, again, your total cost of risk. Now, who here knows what their credit score is? I just had my mortgage done last year, yes. But who here knows what their risk score is? Well, you all know that if you've got a good high credit score, it helps lower your mortgage rates, right? Well, the same theory holds true in the insurance world. If you've got a good high risk score, it can also help to lower your insurance rates. Who here has got 16-year-olds in your family? Anybody? God bless you. I had 3 of my own. And remember when they turned 16, how if your child had a B+ average and went to a driver training school, they actually got discounts and credits, right? Well, again, that can also be done in the insurance world. A client of mine who applied for their risk score, went through the process, they ended up getting a $50,000 credit on their renewal just because of having gone through that process. And again, to those that go to whatsmyriskscore.com is where that process gets started. Let's talk about something that comes out of OSHA called indirect loss cost factors. And what OSHA says is no matter when you have a claim or what claim you have, there's some very real additional costs associated with those claims that you would have. And you can see the notations up there. The factor is 1.1 to 4.5. Just to give you a quick example, got a $10,000 claim. That claim easily cost you $21,000 easily, and that doesn't even include your soft costs. Let's talk about a case study happened to a client about 3 years ago. They had $87,000 in losses, extra $93,000 in additional indirect costs, for a total of $180,000 in total loss costs. And this was their situation. They had 8 claims totaling $87,000. They paid their $12,000 in deductibles, and the carrier paid the rest. But here's where it got interesting. This client really wanted to understand what the cost that his claims had upon his company. And this was his math, not ours. And as you go down through that list, the items should make sense to you. But what came from his own work is that he came out saying, Rick, what's frustrating for me is that when I look at the claims that we had, they really didn't need to happen. With a little bit of training, the losses could have been avoided, saving him a lot of money in the process. Now let's talk about the impact that your losses have on your sales. First off, you've got to know what your net profit margin is as a company. And in their case, their net profit margin was 5%. You simply divide that net profit margin into your total loss costs to find out how much sales you've got to generate in order to make up for the losses that you had. In their case, it was a big number, over $3 million. Now let's put this in your world. How much copper wire can you buy at $180,000? Probably a lot of product, right? Again, controlling your losses helps you buy more product. Now, there was a great article written by Zurich Insurance Company not that long ago that said after every recession, 2 things have happened every time. Number 1, people logically start to rehire again. But number 2, there has always been a spike in workers' comp claims. I've actually already started to see this. Now, we're in somewhat of a funky territory right now because we're in what some are calling a jobless recovery. But there is an overall trend. I've seen people start to rehire because jobs are starting to come back, thank goodness. We've also seen the spike in claims. Now, I also promised you I would share with you a system called a PX4 plan, and to give you a 30,000 foot overview, it goes over 4 different disciplines. And I'm on number 14 in your notes now. The first part of a PX4 plan is your pre-hire process. What does your hiring process look like these days? Then you've got your post-offer step. What are you doing after you've offered someone a job? Then you've got the pre-claim step. What policies and procedures do you have in place before you have your next workers' comp claim? Not if, but when. And lastly, you've got your post-claim step. What procedures do you have in place after you've had that claim? Let's start with the first item, your pre-hire process. What does your hiring process look like these days? Do you have a pretty watertight process in place, or have you gotten rusty in the last couple of years simply because you've not been doing a lot of hiring? Clearly, or hopefully, you don't have any of these people working for you, but you want to make sure that you're doing background checks. Now, your agents or brokers should be doing this for you at no cost, but I put some resources up here for you that you may want to take advantage of because it lets you set up your own account. MVRs probably cost you $10, and you may want to have one of those yourself if you want to do a quick review for your own edification. Some companies these days are doing character assessments, and I put some other resources up here for you as well. There's predictiveresults.com and zeroriskhr.com. Now, these companies generally sport a 96% accuracy rating, helping you from hiring that proverbial dog that can point but can't hunt. And as owners, I think we've all experienced that. These are people that interview very, very well. They tell you exactly what you want to hear, but they're just not a good fit for your company. Again, something that you may want to consider. Something that's very important, and this will also increase your risk score, is making sure that you've got good written job descriptions in your files for all the people that you have working for you. And it's important, and here's why. They're going to be helpful for you as, actually for the doctors, in creating a good return to work program. And we're going to talk about that later on here in just a moment. but they can also help you to keep you from protecting yourself and asking the wrong questions in the interview process and ending up in a discrimination lawsuit. Don't need to spend a whole lot of time here because I'm sure a number of you are probably already doing background checks on your people, but I wanted to put some other resources up here for you that you may want to check out just in case they may charge you lesser rates than maybe what you're paying right now. Now let's talk about the second part of a PX4 plan, your post-offer step. What are you doing after you've offered someone a job? Now let me ask this question. Let me see a show of hands here. Who here is using a post-offer health questionnaire and a conditional offer of employment letter? Don't be bashful. Who's using them? See a few of you? That's good. They are important. They are very important. Here's why. Let me give you a case study. Individual employee had back surgery 3 months before he got hired. Interviews, not a whole lot of questions were asked. And 2 months into the job, what do you think happened? Yep. Had a back injury. Once that happens, my friends, it's like putting you in a canoe without a paddle going down the river. You are in it for the ride. In their case, that loss literally cost them over $76,000 in additional premium caused by the bump in their experience modification. And based on their profit margin, it was about 3.5%, cost them over $2 million in sales to pay for that puppy. So what are you supposed to do? Make sure you have the conditional offer of employment letter. And as far as that letter is concerned, the point here is that you never want to hire someone today and put them on the job tomorrow. Give yourself a chance to be able to check them out and do your due diligence to make sure you're not hiring that proverbial worm in the apple. And another point about medical health questionnaires. Make sure you keep them separate. Keep them separate in all your HR filings because you'll make sure that you are in compliance with HIPAA. So again, keep them separately locked away. Moving on to number 17 in your notes, we're talking about the third part of a PX4 plan called your pre-claim step. And here we're talking about, again, what policies and procedures should you have in place before you have your next claim come through. First and foremost, you should have a drug-free workplace program, which I trust that most of you have elected to have. And if you have, kudos to you. If you haven't, I would highly encourage it. There is a 5-to-1 ratio. Those who do drugs have 5 times more chance of having an accident versus those who do not, period. I had heard some really startling statistics that kind of opened my eyes. Said that this report came out, I want to say a year ago, saying that 75% of Americans report to have used drugs at the job at some point or another. 64% said they actually felt it impacted their work. But what's really shocking is that 44% said they got their drugs from friends from their fellow employees. That was really a shock. Now I know there's people here from various states here. Those who are from Florida are lucky in the standpoint that if you go to the Department of Financial Resources, you actually have the ability to go online and see if you've got a professional workers' comp claimant on your hands. See if they've actually filed claims before. That'd be good intelligence to know. And I want to put that resource up there for you to have access to. Now, this is something also that will help increase your risk score, is do you have an effective return to work program in place? Let's say you've got an employee who's going to be out for a couple of weeks. Depending upon how that case gets managed is going to determine whether or not that case is going to cost you 1 time or 4 times the cost of that case. I was talking with a gentleman about 6 months ago. He was spending $92,000 on his comp policy in a $5,000 claim. And his attitude was, that's why I got insurance, no biggie. I said, no, it's not like that. You're going to continue to pay your $92,000, but you're going to pay that $5,000 back into the system. You're going to pay in addition to your premiums. He didn't quite understand that. Let me give you another example. Let's say you've got someone out for 2 weeks, and their bills totally end up running about $7,000. Once you let the insurance company pay that person's lost wages, you've effectively quadrupled the cost of that claim to your company. From $7,000 goes to $28,000. And again, depending upon your net profit margins, it costs you $750,000 in sales just to make up for that. Bottom line, you want to get your people back to work as quickly as possible. You don't want them home looking like that. And for you cat lovers in the group, like that either. And you clearly don't want them watching TV either. Get them back to work. Now, this was the strategy that we've successfully used at my firm for years, called a salary in lieu of comp strategy. Now, I got to put a caution on this first. This is something I really don't condone people to use unless you've got a professional working with you. But this is the strategy that enables you, the employer, to pay for some of your employees' lost wages for a certain period of time. That, again, kills that trigger that quadruples the cost of a claim. Now, I've had some electrical contractors and contractors in general come to me and say, Rick, let's talk about modified duty work. I don't have any work for them to do. I'm too small of a company. What do you do in a situation like that? Well, what some have done very effectively is they've worked with relationships with local charities to find work for their employees to do, and that's worked out very well. So keep that in mind. Now, I said earlier job descriptions were important. Why is that? They can be very helpful to the doctors in creating some transitional work that the employer can have work done while the employee is getting back to being 100%. Transitional work, doctors can make that happen for you. Again, you want them back to work as quickly as possible. Now, maybe not the way that guy's getting them back to work, but you want them back quick. And arming the doctor with your job description is one of the first things that you want to try to do in the process. And we'll go over that here again in just a moment. One of the first things that you want to make sure you've got at your office is a very good, thorough accident investigation form. And it should be completed by everyone. The injured employees, supervisors, witnesses. Management should also be involved. And one note about witnesses. Make sure you get contact information on the witnesses. I've seen cases go to trial 2 years after the fact, and they can't get a hold of John Jones nowhere, or Ann Smith, or whatever. So just make sure you're getting contact information on them. This will also raise your risk score. Are you asking red flag indicator questions and root cause analysis questions? They're important, and here's why. Red flag indicator questions are great questions that the adjusters love to know the answers to because it helps them in mitigating down the cost of your claim. But your root cause analysis questions help you in determining where your trends might be. So if you're going to end up having training and investing money in training, you might as well invest it in areas where you're having issues, right? Now let me give you some examples of what some of these questions would look like or sound like. First off, an adjuster would love to know, was the job being eliminated? Were there any conflicting stories that happened when you got the written investigation reports from everyone? Was the employee a disgruntled employee? Now, I know that probably never happens to you, but it does happen to some. Lastly, were they properly trained? And were they following the company rules that you have set? Just that last question alone, were they following rules, is important. Again, why? Here's why. If they're not following your rules, something as simple as wearing your seatbelts, which is actually a law, in some states, the carrier has the ability to reduce their claim by up to 25%, which can have a major ripple effect on your company. If you got a $100,000 claim, saving $25,000, pretty big impact. Big impact. Now, I don't want to spend a whole lot of time on this, but I wanted to say something about safety campaigns and incentive programs. Some of you have probably heard about safety bingos and things like that, and they have their place, but they're not condoned by OSHA, and they actually have a short lifespan. And let me ask you this. There's considered to be two types of management styles. There's the carrot style, and there's the stick style. I think you know what those are, right? Statistically speaking, what do you think is most effective in reducing claims that you would have in your company? Who thinks it's the carrot? Who thinks it's the stick? Trick question. Statistically, neither of them in and of themselves work. So what does work? What does work is having a blend, what they call BBS, behavior-based safety programs, where you're looking at the actual behaviors that are causing your losses and having someone measure them, complimenting people when they do right, taking them aside when they do wrong, and making note of it. That's what works these days. Now, in any state, you want to make sure that you're filing your claims quickly. But for those of you who are in Florida, we're what we call a fee-scheduled state. And many states are like this, which means that any medical service that's performed, there is a workers' comp cap as to what gets paid on the amount of that claim. If you or I go up playing softball after church, we break our ankle and go to what I call a doc in the box. My dad was a family practitioner, so I feel like I can say that. They may charge you $200 for that case. But if it's a workers' comp-related case, the cap for that may only be $75, saving you and your carrier money in the process. So again, the moral of the story there is make sure that when people go in for services, make sure the medical provider is only charging you the fee schedule itself. Now, we said earlier, this is more of a philosophy that I carry that seems to be true with most, that 70% of the success of where a claim's going to go for y'all, up or down, really rests on your shoulders as the employer, right or wrong. We said earlier how slam carrier adjusters are, and that you don't want to just blindly trust that everything is going to work smoothly and things don't fall through the cracks. Because if they fall through the cracks at the carrier end, who's going to catch it? Do you think the carrier is really going to care if your mod goes up and your premiums go up? Again, I think you can probably answer that question as well on your own. So we are advocates of making sure that you've got good step-by-step procedures in place. And the first 7 days of any case are critical. The first thing you've got to do is figure out which doctor you want your employee to go to. And when I say which doctor, I'm not talking about that guy. Okay? If you wait too long to get someone to medical treatment, the employee can technically go and get their own doctor, and that doctor may not have the interest at heart and may run up the bill. You want to make sure that you're going to doctors that are in the network that your carrier supports. So keep that in mind. Now, as I said, in the first 7 days, there's a lot of paperwork that you want to make sure is in the hands of the adjusters in the first 7 days. As you see there on the screen, the accident investigation forms, the post-offer health questionnaires that we talked about, job descriptions. Medical releases are very important to have at the very onset. Why is that? Because people invariably will have accidents from 2 years ago or from before, and the adjusters can look at that bit of information and see if there's any coordination of benefits. So keep that in mind. We talked about red flag and root cause analysis questions. And last but not least, you want to make sure that the wage statements are also in their hands. But here's a cautionary note. Make sure they are correct. I've seen employers rush to get this information to the adjusters. The check comes in lower than they want it to. The employee gets their check, and they think, someone's taking advantage of me. So what do? They go see an attorney, right? Just make sure that they're correct. Keep that in mind. Now this may be the most important slide you'll see all day, in my humble opinion. Basically says that after someone has a claim, how should you treat your employees? Comes in 4 words. And the first 2 words are, kill them. The second 2 words are, with kindness. You want to kill them with kindness. Statistics prove time and time again, if you show people the love, they're going to be less apt to find an attorney or have issues. So again, keep that in mind. This is also where the relationship that your supervisors have with your employees is huge. If the relationship is good, you're less apt to have someone try to take advantage and want to stay home watching TV. Now, let's talk briefly about OSHA. Everyone say hi to Hilda Solis. She's in charge of OSHA. In her 2009 swearing-in ceremony, she was actually quoted as saying, "There's a new sheriff in town." How does that grab you? You think the administration's looking for more money? You betcha. Statistics are out that said that OSHA inspectors are actually up. They've hired more people to pass up more payment coupons to everyone. They're actually up 36%, fines up 200%. And what are the 2 biggest areas where they find fines? Not doing training or not having record keeping of the training. So, let's talk about training here for just a moment. There's some great resources that are available. Put some on the screen there. OSHAcampus.com, clicksafety.com. These courses generally run $25, $35 per click. Sometimes you can go back to your carrier and they can find some things that might be at a much discounted rate, maybe $5 or $10. But we're advocates of making sure that you ask for something called a workers' comp claims coordinator training class. This is what teaches your people who are dealing with this the actual policies and procedures, much like we're talking about here today. It's what they call learning management systems, or LMS for short. Again, somehow are very good for OSHA compliance only. A lot of people these days like to have ones that are a little bit more holistic in nature and deal with not only OSHA compliance, but also deal with HR compliance and safety training, electrical training. And for those of you who are concerned about health care, wellness training is also in there. If you're looking to get a learning management system, this is really what you should be looking for. And I don't want to spend a whole lot of time on this, but it has to obviously be easy. You want to make sure that if you're paying your people for their time and attendance, you want to make sure it can track that. And if OSHA does ever knock on your door, you want to make sure that you can show them a report. And within two clicks, that should also happen with these type of easy systems today. Here's an example of one where basically an employee gets a username and password. They would go in, they go into the My Training tab, look at the training classes that they have available for them. They simply click on the launch button, and when they click the launch button, up pops up a class. It's a 15, 20-minute class. There's a test at the end of it. For them to have successfully passed that test, they've got to get a score of 80% or better. And when they get a score of 80% or better, it then ends up on their transcript that they, the employee, and you, the employer, can track. Talking about claims management systems, this is what also is becoming more prevalent. It's simply an opportunity for you to log on your claim online and have it go upload immediately to the insurance company. And at the same time, populate your OSHA logs. I know each of you love doing your OSHA logs, right? So that's something that speeds up the process. Now this is a little bit more Florida specific, so let me kind of pass that. As we talked earlier, as I said, two things to remember. If you reduce your business risk as a company and know your blind spots, and you start that by knowing your risk score, you can and will increase your profitability as a company. In business, you all know that you can win in inches and you can lose big if you drop the baton. Don't let that happen to you. And we talked earlier, don't shoot the messenger, but there is a storm approaching, and quite frankly, it's already upon us. We've already seen OSHA come and increase their number of people passing out payment coupons for y'all. Comp rates are up. We've seen 3 back-to-back rate increases here in Florida. There's talk of a small dip here in Florida by about 0.7%, but the momentum is still clearly moving forward. So what would be a next step? Well, the next step would be to find out what your risk score is. Know your blind spots. Now, whether you do this with me or do this with someone else, you want to make sure that you, again, find out where your blind spots are. Now, here's the good news. Those normally trying to get their risk score would probably cost you $1,500. The great news is for those who are in attendance today, Michael Holt has made available the opportunity for y'all to get that at no cost. So on your forms there, if it's something you're interested in, just put the check mark and we'll deal with it another time. Ending with this comment here, if you want lower insurance premiums, knowing your risk score is a great place to start. Thank you very much. Y'all have a great day.